earnings season in Asia so far? Disappointing, surprising, or as expected?
Well, for Asia, excluding Japan, it's just about as expected, but we've only got about 10% of companies reported thus far, so it's still very early days, but there's a modest earnings miss, about 1%, and that's much better than we saw for most of last year, so we're cautiously optimistic that we're at the beginnings of an earnings upswing. For Japan, where there have been substantial upward revisions to earnings estimates, we've had a modest earnings beat, about a 2% earnings beat. More companies have reported there, about 25% of market cap, and that's a beat for the recently finished financial year.
Why has the risk-reward equation started to deteriorate for Japan equities?
Well, we've got to within about 10% of our TOPIX target, and that target is 1270. And in valuations, we've re-rated from below 0.9 times historic price to book to about 1.3 times. So perhaps more importantly than that, if we look at the relative valuations to developed equities, we're back to 10-year average valuation multiples. So having strongly preferred Japan within global equities for most of this year, indeed from late last year, we've recently become more tactically cautious.
You track fund flows very closely, which had recently been skewed in favor of Japan. Do you expect this anomaly to correct soon, or will Japan continue to be in the limelight?
Well, what we've seen, if you look at global equity funds, is about $25 billion of fund inflows to Japan equity product since this all got going early in the fourth quarter last year. That is the largest period of fund inflows we've seen to Japan equities by global investors since 2005-06, and it's approaching the total quantum that we saw in 2006, albeit that relative to funds under management, it's smaller.
China is out with its official PMI data later this week. How is your China strategy changing with the economy slowing further?
Well, we are overweight China as well as Japan and Australia. I think in China, other than an earnings pickup, what we're really looking at is significant valuation support. If you look at the forward PE for MSCI China, it's still bumping along the bottom around the 90th percentile of cheapness to history. We saw the market do very well in the fourth quarter when it looked like there was a growth pickup. More recently, we've had a sell-off on the somewhat disappointing growth numbers that we've had, particularly for Q1. But through the remainder of this year, we expect that growth situation to improve. And the official PMI will be an important signpost in that regard. But it's not the only thing that we're looking at. We're constantly monitoring the rebalancing of the economy towards consumption-led growth, which we think is well underway here.
You recently trimmed MSCI EM target. What are your views now on Asian equities?
Well, for MSCI EM, our target's 1220. We prefer emerging Asia and actually prefer Asia ex-Japan to global EM. So we have high teens upsides essentially on a scenario-weighted basis to our target prices for Asia ex-Japan, somewhat less for global EM. And when we look at the story that we have here, it's one where valuations have moved back well below long-run average levels. But we expect mid-teens earnings growth for this year, particularly with some of the cyclical sectors, energy, materials, industrials, particularly industrials, consumer discretionary, doing somewhat better this year than they did last year. And then continued strength in earnings growth from the financial sector, which is the largest sector in EM and Asia ex-Japan.